All right, hello and welcome. If you're a business owner, or really any investor, there's this one huge question that's always nagging at you, right? How do you get money out of a company and into your own pocket in the most tax-efficient way possible? Well, as a taxation professor, I can tell you the answer is way more complex and frankly, a lot more interesting than you might think. So let's dive right in. So, today we're tackling a big topic, corporate surplus distributions. I know, that sounds super formal, right? But really, all it means is a company's accumulated profits. We're going to break down all the different ways a company can get that value out of the business and into the hands of its owners, the shareholders. So let's really frame this whole discussion around that one central question. Just imagine for a second. Your company is sitting on a nice pile of cash. Profits are good. What's the smartest way to reward the owners, the shareholders? As you're about to see, the answer is definitely not as simple as just writing a check. Okay, so here's our game plan. We'll kick things off with the basic cash dividend most people know, but then we're quickly going to get into the really interesting stuff, the amazing tax-free capital dividend, what happens when you get shares instead of cash, the super tricky world of deemed dividends that can pop up out of nowhere, and then we'll wrap up with what happens when a company closes its doors for good. Let's get to it. All right, first up, let's talk about the plain vanilla option, the basic cash dividend. This is what most people think of, right? The company pays you cash, you report it on your tax return, you pay the tax. Simple, straightforward. But, and this is a big but, it's often not the most efficient way. And that's what we're here to talk about. We're going to explore some much more advanced strategies that can, believe me, seriously reduce your tax bill. Okay, now we're getting to the good stuff. Let's talk about what I like to call the holy grail for shareholders, especially in a private Canadian company, the capital dividend. Seriously, this is the one you really want to get. Why? Because from a tax point of view, it's pretty much a perfect outcome. It's a way to pull wealth out of a company with absolutely zero personal tax. So, how does this magic work? Well, it's all thanks to something called the Capital Dividend Account, or CDA. Now, this is what we call a notional account. It's not a real bank account with cash in it. It's more like a running tally the company keeps for tax purposes, and it only exists for private corporations. The absolute best way to think of it is as a tax-free piggy bank. The company puts certain tax-free amounts into this piggy bank, and then it can just hand that money over to shareholders completely tax-free. It's fantastic. So let's walk through how this actually works, step by step. Imagine a private company sells, a piece of real estate and makes a $200,000 capital gain. Now, as you probably know, only half of a capital gain is taxable. So $100,000 is taxable income for the company. But what about the other half? The non-taxable $100,000. Well, that's the amount that gets added to this special CDA piggy bank. The company can then formally elect to pay a capital dividend from that CDA balance. And poof, that money lands in the shareholder's pocket, totally 100% tax-free. Okay, so this CDA balance, it's not static. It's constantly moving up and down. Let's look at this example for App Inc. They start with a balance of $300,000. Then, just like in our last example, they add $100,000 from the non-taxable part of a capital gain. But, they also had a capital loss, so they have to subtract the non-deductible half of that, which is $60,000. Now here's a neat one. They also received a capital dividend from another company they own shares in, so that adds another $70,000. Finally, they decide to pay out $64,000 to their own shareholders. You do the math, and they're left with an ending balance of $346,000. And what does that number mean? It means there's $346,000 sitting there ready to be paid out completely tax-free. You can see why this is just such a powerful tool, right? And for the shareholder, someone like Gladys in this example, the result is just beautiful. She gets her share of that $64,000 capital dividend. And for her, it couldn't be simpler. She gets the cash. And that's it. End of story. It doesn't even go on her personal tax return. You don't have to worry about any of the usual dividend stuff like the gross up or the tax credit because there is simply no tax to pay. It's a clean, tax-free distribution of cash. Okay, so capital dividends are amazing, but they require one thing: cash. The company has to have the cash on hand to pay out. But what if a company wants to reward its shareholders but needs to hang on to its cash for growth? Well, that's where our next topic comes in, the stock dividend. It's a totally different way of thinking about distributions. And a stock dividend is pretty much exactly what it sounds like. Instead of getting a check, shareholders get more shares in the company. It's a really popular move for growing companies, right? Because they can reward their owners, distribute that value, but without actually slowing down their expansion by paying out that precious cash. So let's look at this from the company side of things. For Weave Corp, they declare a 5% stock dividend. That means they issue 100,000 new shares. At a value of $2.50 each, that's a dividend of $250,000. Now, that amount gets added to something called paid-up capital, or PUC. You can just think of PUC as the legal capital of the company. Basically, the money investors originally put in to get their shares. So the company's equity section on the balance sheet goes up, but notice their cash balance hasn't changed at all.
Now, what about the shareholder, Mrs. Braid? This is where it gets interesting. She gets 500 new shares, valued at $1,250. And here's the catch. She has to report that $1,250 as taxable dividend income, even though she didn't get any cash. But, and this is a really important but, that same $1,250 is also added to her adjusted cost base, or ACB. Her ACB is just the tax cost of her shares. So by adding to it, it means when she eventually sells all her shares down the road, her capital gain will be smaller. So she pays tax now, but she'll pay less tax later.
All right, so far we've been talking about dividends that companies decide to pay. They're intentional. But now we're entering a stranger part of the tax world. The Income Tax Act can literally create dividends out of thin air during certain transactions. We call these deemed dividends, and trust me, they can be a huge, unwelcome surprise if you don't see them coming.
So what's the logic here? Well, the basic idea is this. A deemed dividend happens when the value of the shareholder's stock goes up by more than the actual value of the company's net assets. It's like value is created for the shareholders that didn't come from the company actually earning more or growing its business. When the Tax Act sees that phantom value appear, it steps in and says, aha, that's a dividend and it's taxable.
Let me give you a concrete example to make this stick. Let's say a company owes someone $400,000. Instead of paying with cash, they say, hey, how about we give you shares in our company instead? And they issue new shares worth $450,000 to settle that debt. Okay, so think about the company's balance sheet. A liability of $400,000 disappeared, so its net assets went up by $400,000, but the value of the shares, the equity, went up by $450,000. See the mismatch? Where did that extra $50,000 of shareholder value come from? That $50,000 is our deemed dividend.
And here is the absolute kicker, the part that catches everyone off guard. That $50,000 deemed dividend. You'd think it would just be taxed in the hands of the creditor who got the shares, right? Wrong. It gets allocated across all the shareholders of that particular class of shares. So you have someone like Kelsey here. She had nothing to do with this whole debt for shares deal. She's just a passive investor. But all of a sudden, she gets a tax slip with a dividend of $833 on it that she has to report as income. This is why you have to pay attention to a company's corporate finance activities. Okay, let's move on to the final chapter in a company's story, the wind-up. This is what happens when a business shuts its doors for good. It sells off all its assets, pays all its debts, and then distributes whatever is left to its owners. As you can imagine, this final payout has its own very specific, very important tax rules.
Now, first things first, we need to be clear about the difference between a full wind-up and something called a share redemption. A wind-up, that means the company is completely shutting down. It's the end of the line. A share redemption, on the other hand, is just when the company buys back some of its shares from a shareholder, but it keeps on operating. The math for taxes is really similar for both, but the situations are totally different.
So let's walk through how a shareholder gets taxed when a company winds up. It's basically a two-step calculation. Step 1 is figuring out the deemed dividend. In this case, the shareholder gets a final payout of $7.7 million. The first thing we do is subtract the paid-up capital, or PUC, of their shares. That's just seen as getting their original investment back. But everything above that, that huge chunk of $7.488 million, that is all treated as a taxable deemed dividend.
But wait, we're not done. That was just step 1. Step 2 is calculating the capital gain or loss on the shares themselves. I mean, they did just sell their shares back to the company. So we start again with the $7.7 million they received. Now, to avoid double taxing the same money, we have to subtract that deemed dividend we just calculated. Then we subtract their original cost, their ACB, and look what happens here. It actually results in a capital loss of almost $1 million. And that loss is valuable because it can be used to offset capital gains from other investments.
Wow, okay, we have covered a ton of ground here. We've gone from these amazing tax-free payments all the way to these weird phantom dividends that can pop up and surprise you. So let's boil it all down. What are the absolute key takeaways for any shareholder or business owner?
Okay, here's what you really need to remember. First, dividend does not always mean cash. It can be shares, or it can be one of these invisible deemed amounts. Second, if you own shares in a private company, you need to know about the capital dividend account. It's your absolute best friend for pulling out wealth tax-free. Third, watch out for those deemed dividends. They can create a surprise tax bill from a transaction you weren't even involved in. Fourth, a single chunk of cash, like when a company shuts down, can be split into two different things for tax: a dividend and a capital gain or loss. And all of this leads to the number one rule. You have to know what type of distribution you're actually receiving.
So, I'm going to leave you with this one thought. The next time you see a dividend check coming your way, or hear that a company you've invested in is making a distribution, will you just accept it? Or will you be asking that all-important question, what kind is it? Because now you know that the answer to that question can make a world of difference to your bottom line. Thanks so much for joining me for this explainer.